my jaw about hit the table because the maximum loan I think we could do at the credit union at the time was like 3 to 5 million to one borrower. This guy's got like 3 to 5 times just cash to spend. Wow, we're in a really fortunate position to work with some really incredible, hardworking people. And it's great when you're working with good families too. All of a sudden, the market has become somewhat stagnant to where folks who have that 3-4% debt, they would sell, but they're not going to at the moment because they'd have to go and buy at 6-7%. So we can look at the math. We can look at the investment strategy, we can look at different types of construction, but at the end of the day, to actually get a deal across the line, we're dealing with people. I think the market is difficult, but I think for the listener is to understand that there's still opportunities in every market. Doesn't matter where we're at in the cycle economically. If you search hard enough and you work hard enough, you will find the right opportunity that you're looking for.
Hey everyone, welcome back to another episode of Commercial Connections Investing with Confidence. I'm Rene, the podcast producer, and today we have an excellent guest on the podcast with us today. Isaac Grant is here. Isaac is a commercial real estate expert with a background in real estate lending. Isaac moved from Oxford, England to Oregon in 2009 after he met his wife, Rachel. That's when he found his passion for real estate finance and earned his CCIM designation, and has since built a reputation for bringing a numbers-driven approach to investing. Over the years, he's worked with different asset classes and helps investors maximize their portfolios with smart financial solutions. His deep knowledge of the Oregon commercial real estate market and strong industry connections make him an invaluable resource for investors. Beyond his career, Isaac and his wife have built a beautiful life in the lovely Oregon countryside. They have 4 beautiful children. He loves taking adventures in the great outdoors, from hiking and camping and just being out with his family outside. Leading today's conversation is our host, Rene Nelson, an award-winning CCIM in the Eugene, Oregon area. Rene has spent years helping investors grow and refine their portfolios through commercial real estate investments. I just want to say thanks for being on the podcast, Isaac.
Thank you. I mean, wow, what an introduction. I don't think I've ever been given such a flattering introduction. So, yes, I'm not sure if all of the above is completely accurate, but the stuff about my family definitely is. So, yeah.
Aww.
Yeah, it's a beautiful sunny day in the Oregon countryside right now. I'm looking at the lovely green trees in the Oregon sort of coastal range. And yeah, we love it. We love living here. Great place to invest.
Yeah,
Absolutely.
So let's talk about that. Isaac, you've built a strong career in commercial real estate, and now you're a CCIM. Why don't you just talk a little bit about your career path and how you went from being a commercial banker to a commercial real estate broker?
Yeah, like Brittany said in her introduction, I moved here in 2009 as a young chap. Great time to get a job, right? End of 2009. So I think I arrived, got through, as a foreign national, you got to get through all of the paperwork and what have you. We did it legally, even though jokingly I had some folks advise me that maybe you just fly down to Mexico and what have you. But I didn't do that. I came in the proper route. So yeah, it took a little while to get started, but then I'm just throwing my resume around town, honestly, just trying to find a career path. Wasn't particularly looking for banking, but it's what I sort of fell into. So back then I just got started, honestly, at a local credit union as a part-time teller, moved into sort of the consumer side of doing credit cards and home equities and auto lending, that kind of thing, but learned very quickly that probably wasn't going to satisfy sort of my drive and ambition. So position came open for business development, and I'll be honest, I didn't even really know what I was applying for when I first got into a business development position at a local credit union. It sounded good, right? Business, it had the word business in it. So I was like, that sounds better than taking credit card applications. So got into the role and very quickly just grew a passion for commercial real estate. I saw that as just a great way to grow my career in lending. And part of that process here locally was just trying to kind of build a network. And that's where I met the wonderful Rene Nelson, CCIM, and her husband, Bob, at a local, it was called CID back in the day, Commercial Investment Division of Lane County. We met in the basement of the old Red Lion Hotel, which is no longer there on Coburg Road. It's now a natural grocer's store. Interesting place to meet, but it was a good group. We'd meet there once or twice a month and grab coffee. And it was just fascinating to me to listen to all of these seasoned professionals pitch properties, do some marketing, talk about the local economy. Obviously, at that time, we're looking at about 2012, 13. Things were starting to slowly recover from the depths of '08 through 2010, 11. So it was a really interesting time. But one of the great things, and something I'll be forever grateful for, was Bob and Rene invited me up to the CCIM meeting. So CCIM is Certified Commercial Investment Member, and you have to go through a pretty rigorous process to get that designation. But to begin with, I just went as a lender, local banker. I remember on my first meeting there, so Bob said, you got to wear suit and tie. So I'm like, okay, I'll put on my suit and tie. And I kind of like that, being from England. That's kind of our style, is more suit and tie, no matter what profession you're in. So I was like, yeah, okay, I can get on board with this. So I show up to my first meeting, and they're meeting at the Multnomah Athletic Club, which is slightly different to the basement of the Red Lion Hotel in Eugene, Oregon. I'll tell you that. So, whereas we went into sort of the somewhat dingy and much need of an upgrade Red Lion Hotel basement, you go to Multnomah Athletic Club and it's massive staircase, beautiful carpet, everyone's in suit and tie, chandeliers from the ceiling. You know, it's the full 9 yards, so to speak. So going to that meeting, I felt like a very small fish in an ocean, but it was in a good way. I was like, this is a place where things are happening. These are some of the real players in commercial real estate, and I can learn a heck of a lot by coming to these meetings. And part of those meetings, when, you know, folks will get up and they'll pitch their properties and talk about what they need. So, you know, hey, we have a situation, either we have cash looking for a property, or we've had this listing for a while and it's not moved, you know, so trying to get help from the room because you have so many great professionals in there. I remember this one guy gets up and it's like, yeah, so we're coming out of a 1031 exchange. At the time, I don't know what a 1031 exchange is. No, so that's the first time I've heard that sort of terminology. He's like, yeah, we're going to have about 15 million cash to place when we come out of this 1031 exchange. My jaw about hit the table because the maximum loan I think we could do at the credit union at the time was like 3 to 5 million to one borrower. So I'm like, this guy's got like 3 to 5 times just cash to spend. And so I'm looking at him like, okay, for one, you know, someone is going to have $15 million of cash to spend. Never met anyone with that kind of resource to go invest in real estate. So I'm like, okay, as much as I feel like a small fish in a big ocean, this is a good room to be in if these are the types of deals that we're talking about. So joined as a power partner sponsor, have kept going to CCIM for the best part of a decade. And then right around as COVID was hitting, I realized as a lender, you could actually get the CCIM designation. So you take the 4 classes, you have to submit your portfolio of deals that you've done. And so I was like, okay, I think I'm going to go for it and get this designation. So started the classes, and honestly, I absolutely loved the classes. It was a little daunting going in as a lender because you're like, these classes really for brokers. They probably are directed more at the broker world, but I just learned so much in that first 101 class that I was like, okay, I was going to take maybe 3-4 years to get it done. And after that first class, I was like, I think I realized the final exam was in Seattle, which isn't too far from us the following year. So I was like, I'm getting this done in 18 months. I'm just going to go through this and get all the classes done. So that's kind of a long story, somewhat short, on how I went from being a part-time teller into now being a commercial broker. So I got that CCIM designation just over a year ago, October of 2023. It's March 25 now. I was still a banker at the time, but a couple of months after getting my CCIM designation, a few folks were like, hey, we saw you got your CCIM. You ever thought about becoming a broker? Banking was slow at the time. And so I just thought, you know, I'll start looking into this. But obviously interest rates meant that the whole industry was struggling. But it was just over a year ago, probably about 13 months ago, I was sat in this very chair and Rene reached out and said, "Hey, you got time for a quick phone call?" Of course, it's Rene Nelson. So I said, absolutely. So we hopped on the phone and she was talking about a 1031 exchange. Now, obviously, a few years later, I knew what that meant now. So she said, "Hey, I got these clients who are doing a 1031 exchange." And she invited me to be part of that process, which I'll just be eternally grateful for her giving me that opportunity. So that really helped me make that leap into becoming a broker. And we just had a blast last year. Last year was a great year where we got 2 deals done for those clients. And yeah, I haven't looked back. So that was kind of my path into becoming a CCIM broker.
And not to kiss and tell, but that buyer range was like 30, 32 million. So when Isaac fell off of his chair the first time at 15 million years ago, yeah, he just really surpassed that in the deals that we just did.
Yeah. So. Yeah. When you first start hearing those numbers, then it almost, after a few years in the lending, it just, I don't know, you do get a little desensitized to how big those numbers are because you're seeing them every day. So every now and then it is good to just kind of sit back and be like, wow, we're in a really fortunate position to work with some really incredible, hardworking people. And it's great when you're working with good families too, which is what that situation was last year. You're just working with really good local folks. So yeah, it was a lot of fun.
Well, and I think part of what you and I enjoyed is we were able to use our CCIM skills. So you and I know the value of the CCIM education, but for the listeners that are unfamiliar with that, why don't you talk a little bit about what opportunities and skills the education and the tools from CCIM, what that gives you for like a competitive advantage in structuring deals, putting deals together, and advising clients?
The statistic that I'm aware of, I don't know if it's 6 or 10%, but it's definitely less than 10% of commercial brokers have the CCIM designation. So it's a highly sought after and, like I said, a very rigorous process to actually get the designation. Not everybody passes the final test. There's no guarantee that just because you take the classes that you're going to be able to get the CCIM designation. So yeah, it just gives you a competitive advantage and a real sort of an acceleration through the process of learning to where you have tools that other brokers don't have when it comes to analyzing properties, analyzing markets, running through the different metrics that different investors are going to be looking for. Not everybody's looking for the same thing, whether it be a cash on cash return or an internal rate of return. Maybe they're looking at, okay, how can we take the profits that we make off of some of these properties and invest in other things, and you're looking at capital accumulation. All of these terms, a lot of commercial brokers aren't even going to know. So the CCIM, I just can't speak highly enough for how they really walk you through. I think once I reached the 104 class, the instructor said, this is like a sort of graduate level finance course in 1 week. It's kind of what boils down to. And they just do an incredible job. I can't speak highly enough of the instructors that I had of taking you through a really dense amount of material in such a short period of time. So it really opened my eyes because as a lender, we were always looking at historical data, which is what lenders should do. They're looking at, okay, how has a property performed historically? That gives us an indicator as to how much debt we can really place against this property and feel comfortable that we're going to be paid back what we're lending. A little bit different when you get into newer properties and construction loans, because then you are looking forward at a projection. And so you're really relying heavily on some of the market data, what the appraisers are going to be giving you for data on rents. But primarily, lenders are looking more historically. When it came to CCIM, they're really looking at it. They teach you a lot of the lending things as well, which is good. And loan structures, loan to value, debt service coverages. We can get into all of that. But the thing that my eyes were really open to in CCIM was how to look at it from the investor's point of view. And that's really where the best skilled commercial brokers have a step above in the market, is when they can really boil down to what is this investor looking for and how can I put myself into the investor's shoes? So instead of just trying to sell them on a property with an offering memorandum, it's really having that active listening and understanding what are the goals of the client so that the client can be the hero of the entire transaction and we get the client what they need. And so when you look at it from the investor's point of view, the client's point of view, you really are looking more on the go forward. Yes, you want to look at the historical to be like, okay, is there some really negative trends here? Then you can ask more questions. What's causing that? So you want to understand the history, but you're really looking at, okay, when I buy this property, I'm not getting the income stream from the historical. I'm getting the income stream from the day I buy it forward. And so how can we project and predict with as much certainty as possible what that's going to look like? So that's where the CCIM really paid dividends for me, was being able to look at it from the investor's point of view.
So we know that commercial real estate is full of opportunities, but we also know that it can be fraught with problems. Talk about kind of the toughest deal that you've done lately and how you were able to get it across the finish line. And I think you could probably talk about one of the deals that we did and kind of what we went through in the analysis trying to advise our clients.
Yeah, I think in the current lending environment, so as we're recording this is March 2025, interest rates haven't come down. You know, folks have been talking for 2 years when a rate's going to come down because they spiked so quickly. It really caught the market a little off guard. I think people knew that they needed to go up, but didn't realize how quickly those interest rates were going to go up and how that was going to affect commercial investments across the board. So for us last year, we were in a really fortunate position that the buyer had all cash. So that really helps the transaction because you're eliminating that finance piece, which a lot of people are finding so tough because you need more cash to make these deals pencil based on where the prices are. But like Rene said, it doesn't mean that just because they're an all cash buyer, there aren't going to be hurdles that you need to overcome and things that you need to work through. So on the first deal, especially, it was new construction. So again, there's not really any historical data as to, well, here's the net operating income from this property because they'd only just got it leased up. So you're really looking at a projection forward, and the offering memorandum, which is like the marketing package that the listing brokers had, they have their projection in there. So they're like, okay, these are the income items. This is our projection of the expense items. So we think this is going to be the net operating income number. From there, you can apply a cap rate to that net operating income number, and that gives you the value. So they've done that in their offering memorandum. In all fairness, it looked really quite fair. Their projections seemed pretty solid. As we started diving into it, so once you're under contract, you can get a little bit more information. So you get some of the actual profit and loss statements that show monthly tracking, where's the income coming in, where are the expenses coming in. One of the things that they had projected on their original marketing package was that they were going to charge all of the tenants for parking. So they were projecting on an annual basis, they'd probably have about $45,000 a year just for parking spaces, not for renting the units that folks are going to live in, but just for the parking on the outside. When we got the additional information to show, okay, are they actually getting all of the income that they predicted in their marketing package? There was little to no parking income at all. So that line item, they had a line item in there for parking, but they were getting maybe, 100, 200, 500 a month max. I mean, they were hardly getting, they weren't going to hit $45,000 in that first year for parking. Well, that affects the bottom line net operating income because all of a sudden we got $45,000 that was projected that's now missing. So Rene and I remember a couple of Saturdays even, we're on the phone and on Zoom with Excel sheets up, going literally line by line. And for any Excel geeks out there, I mean, we're literally like, hey, I'm in cell S37, or I'm in 36. So, we're just making sure that we're tracking all the way down so that we get to the same number once we've analyzed all of these Excel sheets.
It was like being on a bingo card. B9. I37.
Yeah. And on my end, I'm literally like highlighting the cells once we've agreed on the number. We're like, okay, that one's done. On to the next line item.
Yeah.
Well, we went through the whole thing. and had a pretty airtight defense of our numbers, which we were able to go back to the seller side with their representatives and say, listen, we've got the information, we found this. And so we were able to negotiate a little bit of a different price. I don't know what you think, Rene, but my limited experience so far as a broker, you want to try and get as much information up front as possible so that you're not having to renegotiate price unless there's really obvious errors. So this was just one of those situations where we thought we'd offered a really good price based on the information we have. Then you get some additional information. It's like, well, actually, this does change what we'd be willing to pay.
Two things. You're spot on, Isaac, because the listing broker, when the offer was accepted up front, said, okay, the developer is a take it or leave it person. So do your due diligence, but don't expect that you're going to come back. It's called a retrade in our industry. Yeah. And it can be a negotiation ploy. Most people have stopped doing it, but in the years past, they'd rush in, make a full price offer, knowing that they were not going to stick to that price and they were going to come down. And so this broker said to us up front, don't expect to retrade or come back for a price concession, because the developer will just keep the property and he'll refinance it and keep it in his portfolio. So we knew that we had to represent our buyers and do the best job for them. And when we presented the numbers to them, their marching orders to Isaac and I were, okay, go get my price reduction, but don't lose my deal.
Right.
And it was like,
you had to bring that airtight case. Yeah.
And we started at a much bigger number because we had to go through a couple of rounds with the property manager. So then you get another layer of, cooks in the kitchen, so to speak, really to where everybody was comfortable with, okay, yes, the parking wasn't there. Maybe there was some expenses that can be reduced due to management, etc. So once everybody was on the same page, we were able to get about a $75,000 price reduction, which everybody agreed was fair. And like Rene said, we had our marching orders, don't lose the deal, but we need a bit of a price reduction. We were able to get it done. So that was really, really cool.
So Isaac, why don't you talk a little bit about what you're seeing with banks and lenders? Because I know you and I talk about this a lot, about having banks meet buyers in the middle right now where, like you said, interest rates are higher. We've got people that are going to be in a situation where they're going to need to refinance because their note's coming due. I think a lot of investors are wondering if we're headed towards a soft landing. What's your thoughts on that?
Yeah, I think it's a really interesting time with the banks. So again, to try and make sort of a longer, broader story short, here's sort of what happened. We hit COVID and rates bottomed out, right? I mean, we had residential 30-year mortgages in the 2.5% range, unheard of. Commercial wasn't far behind. We had commercial rates at 3%, 3.5%, fixed for 10 years. On some multifamily, maybe through HUD, Fannie Freddie programs, you can get 30, 35 years fixed in the threes. I mean, just a once in a lifetime low interest rate environment that we probably will not see again in our lifetime. So what that meant was the banks were flush with cash and just handing it out. This is just the industry at large. This isn't one bank in particular. The industry at large. This money's going out at really low interest rates. Well, then 2-3 years ago, when the rates kicked up so quickly, all of a sudden the market has become somewhat stagnant to where folks who have that 3-4% interest rates, 3-4% debt, maybe they would sell, but they're not going to at the moment because they'd have to go and buy at 6-7%. So if they've got another 5-7 years at 3% interest, there's just no incentive for them to sell that asset, even if this is the point in their investment cycle where they usually would. You see this especially with value add folks, where their whole business model is, we're going to buy an older property, whether that be apartments or an office or retail. It's old, it's maybe got some deferred maintenance, so we're going to buy it. Our interest rate's 3-4%. We're going to put X amount of dollars into it. That means we can charge higher rents because we now have a nicer, more attractive property. Then we go and we sell the asset and we move on. We do the same thing again. We find another maybe slightly decrepit property and do this again. What I'm seeing at the moment is a lot of those folks that bought those properties 4 or 5 years ago, they're at the point where they would sell, but they're not going to, for the reasons I just explained. They're not going to go get a 7% interest rate on a property that needs a bunch of work. So their business model is somewhat stuck, but they're okay financially because they can just hold the asset and they're fine off of the income stream of the asset. They're making a profit. I've shared this with 4 or 5 banks now because I'm trying to find someone to poke holes at it. I've even met with a chief credit officer of a good-sized community bank in Oregon who was open to this idea. Because what I see at the moment is banks, a lot of them, what's called their loan to deposit ratio. So how many deposits do they have on the books? That's typically the money that they can use to lend versus how much debt they have on the books. It's become squeezed. Some are maybe even upside down to where they have more loans on the books than they do deposits. Some of them are waiting for the unicorn to fly by on the magic carpet. They want folks to come in and pay off entirely, loan that's at 3%, and then they can reloan that money at the 6.5%, 7.5% market rate. That's not happening. That's why I call it the unicorn going by on the magic carpet. It's not happening. It's not going to happen. People aren't going to do that unless they're in a really difficult situation where they're forced into needing to sell. But the majority of the market does not need to sell, and so they're going to hold that lower interest rate as long as they possibly can. So my idea I've proposed is, listen, for some of these investors who maybe would sell, why don't the banks just meet them in the middle and say, listen, if you're at the point in your investment cycle where you would usually sell the property and you actually are interested in selling the property, but the only thing holding you back is the interest rate, if you keep that loan with us and we can qualify the next property that you're going to purchase, why don't the banks offer them like a 5% interest rate? So it's like, okay, market's at 7, but their debt on the books is 3. Why not meet them at 5? The bank makes more money that way. For me, it's a win-win. The investor gets to move on to the next property. The bank increases their net interest margin because I think a number of investors would take them up on that deal. And it helps us get out of this sort of stagnant situation. So that's one idea that I've just had that I'm trying to propose to banks to see if that'll help move the needle, both for investors and for the banks that are struggling on margins because they're having to pay more for deposits and the debt on their books is low and isn't going to change until those notes mature. The other thing you asked, Rene, is in regards to a soft landing. That is a really difficult one. I don't know where the quote landing strip, have we landed already? Are we still a couple of years out? I mean, that's a really difficult one to predict. I think folks are definitely starting to get used to this interest rate environment. And anyone that says, well, we're going to see 3 rate cuts this year or 5, or we're going to see they're going to drop to, nobody knows. Anybody that says that they know, they're either super, super intelligent beyond my limited understanding of economics, or they're just making a wild guess. It's one of the two, in my opinion. So from my perspective, it's just having investors especially just understand that the margins that they were getting 4 or 5 years ago were a once in a lifetime opportunity. We're just not going to see those margins again for some time, at least. So can we find ways for them to keep their investors happy? A lot of these folks do, syndications. They have an investment group. It's not just, one individual buying an apartment complex. So it's finding ways for them to get used to margins that are not the same as some of their other properties that they had, but understanding that there are still opportunities out there that do make sense.
Okay, thank you. That's great insight. So part of my passion in this podcast is to educate our listeners. And I kind of use Brittany as my test case. So Brittany, I know you are intrigued with real estate investing and you're doing a lot of studying on that. What questions would you have for Isaac from maybe his lending background or now as a commercial broker? If you could ask him some questions, what's of interest to you?
I think just that last topic that you pointed out, I mean, it was once in a lifetime. how, and you come from a lending background and banks need to meet in the middle. And you've said you've met with some people. So in your dream scenario, is it you leading your clients to it? How do you get that process started with getting all the people on board?
Such a great question. I think so much of our industry is actually the people business. So we can look at the math, we can look at the investment strategy, we can look at different types of construction, we can look at market analysis and geographies. But at the end of the day, to actually get a deal across the line, we're dealing with people. And so the main thing is to build relationships, and that takes time. So I don't think that there's a quick answer to your question. I think it's making sure that you have the right relationships with the right decision makers across the board. So like for me, because of my banking background and knowing a lot of folks in that banking industry, it gives me access to some of those chief credit officers and chief lending officers to be like, hey, let's just go have a coffee, discuss it as at sort of the philosophical level first, as opposed to being like, hey, I've got this client with this need and they have a loan with you. And so, hey, this is what I need you to do to get it done. You're probably going to get a little bit of a wall going up. But if you can just kind of discuss things philosophically, they've got to think about that stuff. I mean, they've got to answer to the bank board, and they've got to talk with their CFOs. And there's plenty of decision makers that go into those sorts of conversations. So I think having those relationships is one of the most important things. And then getting everybody to agree to those sorts of ideas. I think it's that sort of creative thinking that's going to help folks in the next couple of years while we're still in this position. I think where it's going to get really interesting is when that 3-4% debt starts to either adjust. So a lot of commercial mortgages, maybe it's a 10 or 15 year note, but the rate adjusts every 5 years. So we're going to start seeing over the next couple of years, those 5-year adjustables, 3-year adjustables, 7-year adjustables, that rate's going to change. Or you might even see the balloon payment situation where it's like the note's just due. So if there's not a refinance option with that institution, you either owe the whole thing, or you've got to find somebody else to refinance the debt. Or if nobody wants to give you a loan on that property, you're going to have to sell. That's, I think, coming in the next couple of years, and that's going to be really interesting to see how that works. It's starting now, and this is something that I'm seeing that's quite interesting. I have a particular client who has multifamily. They did a great job. They bought, I think it was like 1990s vintage. So back in 2020, they purchased this asset, and over 5 years, they've done the remodels as the units have turned, raised the rents. It's now worth much more than what they paid for it. But they were on one of those 10-year adjustable mortgages. So the 5-year adjustment just hit. And those are typically already built into the loan. So it's going to be FHLB, which stands for Federal Home Loan Bank, plus a margin, whether that be 2.5%, 3% over whatever that rate is at the time. A lot of banks use the US Treasuries. So the 5-year Treasury or the 10-year Treasury, plus a margin, and that's baked in. So their rate, I don't know the exact rate, but for example's sake, I think it went to around 7%. Now, if they were to sell that asset and go and buy something else, we can get a different bank or credit union to probably give them 6.25% for 5 years on an interest rate. So the current bank, instead of being like, hey, market rates are at, 6.25%, 6.5%. I know this is baked into the rate, but we want to keep your business. A lot of the banks are like, hey, it's either this top dollar interest rate or, you're going to need to refinance somewhere else or sell the asset to get those lower interest rates. We haven't seen that. Historically, banks were in the business so much that they probably work to try and meet where the market might be, but it's just so different from lender to lender. Some are still very bullish on multifamily, and they have that margin on their balance sheet where they still have money to lend, so they can do those deals. Others, they felt the squeeze so tight, they're actually probably okay with you paying them off. They're like, we love you as a customer, but if they can get loans off the books, it benefits the bank. So it's really finely balanced at the moment. And your guess is as good as mine as to which way some of these things are going to fall.
It's crazy.
Yeah.
That's so interesting, though.
Yeah. Yeah. Interesting is a very good word for it. Yeah.
Yeah. It's good that you use that example, though, with the current client that you have coming up, and like how you said, like the different options that the bank might give them and what the pros and cons of using like refinancing or going with a different bank. Yeah, that makes a lot of sense.
Isaac, let's talk a little bit too about what you and I call the food groups or the product types that you're seeing in the Eugene-Springfield area. You and I have chatted that multifamily is kind of tough right now. What other opportunities are you seeing in our market?
It's a great question, Rene. I love multifamily because everyone needs somewhere to live. And I love the thought process that we're helping in some way with that. We have such a housing need in our area. It's interesting because typically when interest rates go up, prices come down. That's just sort of a macroeconomic idea. But because of supply and demand, and because we have so few units, prices really haven't come down. If anything, they're still creeping up ever so slightly. So to get those deals to pencil, you think of an apartment complex with 25 units. It's not one of the tenants. It's not like someone in unit 25B going to buy the entire thing. It's going to be an investment group. So they're looking for a return. They're not looking at it from an owner-user point of view is the terminology we would use. So that sort of just pure investment side, like Rene said, is pretty tough right now to get some of those deals to pencil. What I'm seeing in our market that is still quite strong is more of the owner user, where there are businesses expanding and growing and doing a great job. They need more space or they want to try and find land to build. Those sort of industrial, light industrial, manufacturing, distribution. I mean, you just think of how much of the retail consumer has switched to online, and we need that distribution space and that warehouse space. Even, I would say, in our local market, sort of nice suburban office. We don't have a lot of higher end office in Eugene-Springfield, but from my vantage point, I think we didn't overbuild office in our area. And so some of the smaller owner user offices, I think are going to actually remain pretty strong. I think office is getting a bad rap because of so many folks that have gone to work from home. So yeah, some of the skyscraper office buildings in downtown Portland, they're going to struggle. I think owner user office in our area is going to stay fairly strong because I think we're starting to see that going into the office and seeing people is actually good for us as humans. And so folks are starting to want that more. And especially for younger professionals as well, it's hard to find that mentoring relationship and build that network from just behind the screen at home on Zoom all day. Actually getting out and getting that experience and being in the office and being able to just put your head around the owner's door and ask a question is really invaluable. So some of that light industrial owner user office space, I think, is actually going to remain fairly strong over the next couple of years, especially because I don't know what you're seeing, Rene. I'm not seeing a lot of new office being built. So I think that's going to be something that helps us here locally. I think retail, it depends. I think the cap rates on retail have started to go up a little bit more. So that means it's easier to make those investments pencil compared to multifamily based on where interest rates are at. But you're still not going to have the margins that you did 3, 4, 5 years ago.
So, Isaac, if you wanted our listeners to hear one thing about the market, what would you say about the Eugene-Springfield market?
Oh, I wish I had it pulled up in front of me. I think I'm going to start doing some posts on how many properties are available in our market. I think so many people think inventory's down, which maybe it is compared to historical numbers, but we still have a good market. You know, we still have industry, we still have jobs, we still have slightly increasing population in our area, which means real estate is a need. You know, where there's people, there's going to be real estate needs, whether that be housing, amenities, shopping, etc. So I think, yes, the market is difficult, but I think for the listener is to understand that there's still opportunities in every market. Doesn't matter where we're at in the cycle economically. If you search hard enough and you work hard enough, you will find the right opportunity that you're looking for.
And I know industrial is becoming now your new pet. So if
You
our
know,
listeners want to reach out to you, go
yeah.
ahead.
Yeah, no, I was just saying industrial is something that I'm learning a lot about. So my principal broker, Matt Hogan, has his SIOR, Society of Industrial and Office Real Estate. And so learning that side of the business from him over the last year or so has been really fun, actually, to see how that really helps our local economy as well. So yeah, if you're looking at industrial deals, we have plenty of stuff that you can look at for sure.
So if our listeners want to get in touch with you, what's your LinkedIn or what's the best way to reach you?
Yeah, best way to reach me. I mean, cell phone is great. 541-525-6907. My email is isaac@cwwalker.net. You can find me on LinkedIn, Isaac Grant CCIM. Yeah, would love to message with folks, contact folks. And yeah, Rene and I can help you out with whatever real estate needs you have.
We'll make sure and put that in the show notes. So
Absolutely.
Brittany, what's one thing you learned today from Isaac?
How you're getting more into the industrial space. I think that's really interesting because I feel like there are a lot of manufacturers in Oregon. Like specifically, we have like kind of a big manufacturing business here in like different ways. So that's what that is more about. Like that's what the space is.
Yeah, I mean, you have no idea some of the amazing industries that we have in our local market, from wood products to manufacturing to biotech to distribution centers for stuff. Yeah, I had no idea that we had some of the stuff locally with 150,000 square foot buildings. Yeah, it's
huge.
really a great look into how some of the stuff in your house gets to be in your house or stuff at the local store gets to be at the local store. I think we're so quick in our living that we don't really slow down sometimes to think about, how did this actually get to physically be here in this store? Yeah.
It'll be interesting to see with tariffs and some different political environment that's happening, to see if we have more development for business and distributions that want to stay local rather than maybe going overseas and stuff. So I think we're in for an interesting time in the next year or two.
Yeah, it'd be great to have you back to see like what you found over the industrial space.
Yeah, absolutely.
Yeah, Isaac, you'll have to come back at the end of the year and give us a recap on what you've seen.
I look forward to it already.
Isaac, thank you for being here. Thank you for participating and being you, man. Thank you.
Thank you guys so much for inviting me.
Next time on Commercial Connections.
Start with your exit strategy in mind. When you're buying a property, ask yourself, how am I going to get out of this? Am I going to buy my partners out? Am I going to buy my parents out? Are my parents going to give me this money as a gift? There's a difference between getting a gift. There's a limit for how much you can be gifted.
From a family member.
Yes, by a family member. So if your family is giving you money, that's one thing. But if they're putting money into a property, now the IRS looks at them as an investor. They don't care that it may be your mom and dad or your brother and sister. They look at it that person is an investor with you.